In 1972, a man invested $50,000 into a concrete box in El Cajon, California. No technology, no patents, just empty rooms where people stored their junk. That single investment built a fortune of $3.3 billion. He's not the exception. The most boring businesses on earth are quietly creating more billionaires than Silicon Valley, and they all follow the same 6 rules. Not every plain-looking company is a gold mine. To spot the real wealth machines, you need a filter, one built on hard numbers, not hype. First, look for businesses where at least 60% of revenue comes from repeat customers or contracts. Think monthly bills, not one-off sales. If customer churn creeps above 12% a year, walk away. Steady demand is non-negotiable. The best candidates operate in markets crowded with small players, not dominated by giants. That fragmentation means a smart operator can buy up rivals and grow fast. Next, check the capital intensity. If a company spends more than a quarter of its earnings on new equipment or buildings, it is probably too heavy to scale without risk. Regulatory barriers matter too. The more licenses, permits, or local contracts needed to compete, the harder it is for new players to break in, and the safer your margins. Finally, operating leverage is the silent engine. If a 10% bump in sales triggers at least double that in earnings, you are looking at a business with real compounding power. When an industry hits 4 out of these 6 marks, it is not just boring. It is a billionaire blueprint hiding in plain sight. B. Wayne Hughes didn't look for excitement. He looked for opportunity nobody else wanted. In August 1972, he and Kenneth Volk Jr. scraped together $50,000 to open a self-storage facility in El Cajon, California. No fancy tech, no buzz, just rows of metal doors on leased land, designed to be cheap to build and even cheaper to run. Hughes understood something the market missed. People always need more space, and they'll pay for it month after month, no matter what the economy does. Instead of buying land outright, Hughes negotiated land leases, freeing up cash to expand faster. The first units filled quickly, and the formula repeated. Standardize the design, keep maintenance low, and focus on occupancy. With each new location, the cash flow grew more predictable. By 1980, Public Storage had gone public, and soon after, Hughes converted the business into a real estate investment trust, or REIT. This move unlocked a tax-advantaged way to funnel profits back to investors, while giving the company a war chest to buy up smaller rivals across the country. What started with a single lot turned into hundreds of sites, then thousands. The playbook was simple. Find fragmented markets, roll up the competition, and let the steady drip of monthly rent compound into billions. Hughes didn't chase trends. He built a money machine that scaled quietly, stacking standardized assets until Public Storage became a national giant. The empire was hiding in plain sight, powered by a business most people barely noticed. Picture a regional pest control entrepreneur with an eye for numbers, not headlines. She spots a small operator doing $5 million in annual revenue with a modest $1 million in EBITDA, a 20% margin. The deal closes at 5.5 times EBITDA, so the check is $5.5 million. But the real game starts after the handshake. First, she slashes redundant overhead, folds billing and scheduling into her own back office, and launches a subscription plan for regular treatments. As recurring revenue climbs from 20% to 30%, the EBITDA margin jumps to 30%. Now, the same $5 million in revenue throws off $1.5 million in EBITDA, a 50% lift in cash flow without adding a single new customer. With stronger margins and more predictable cash, she can borrow against the business at better rates. That extra $500,000 in annual profit funds the next acquisition, letting her repeat the process. Each roll-up amplifies the effect. Buy at 5.5 times EBITDA. Improve the margin and watch the cash pile grow. The cycle turns one plain pest control shop into a compounding engine ready for bigger moves. The math that quietly builds fortunes while everyone else chases the next big thing. Warren Buffett built his fortune on a simple question: how can you buy billion-dollar assets without paying billion-dollar prices? The answer sits at the heart of Berkshire Hathaway's empire: insurance float. Every year, Berkshire Hathaway's insurance companies collect premiums up front and pay out claims later. That pool of cash, often called float, isn't just sitting idle. It's a near-free source of capital, available for Buffett to invest as he sees fit. By 2009, Berkshire's float had grown so large that it could bankroll deals other companies could only dream about. That year, Buffett made his boldest move yet: a $44 billion buyout of Burlington Northern Santa Fe, the nation's largest freight railroad. The deal was a masterclass in capital allocation. Berkshire put up $15.9 billion in cash, issued $10.6 billion in new stock, and took an $8 billion in debt. But the real secret weapon was the insurance float, cheap, flexible money that let Buffett act fast while rivals scrambled for loans. Once BNSF joined Berkshire, the cash started flowing. In 2010, BNSF generated $4.5 billion in operating earnings and $2.5 billion in net profit, a 40% jump over the previous year. The railroad began sending nearly $1 billion a month into Berkshire's treasury, fueling even bigger bets across the conglomerate. For Buffett, float wasn't just a financial trick. It was the engine that let him scale from buying up small insurance firms to owning a continent spanning rail network. This is how boring businesses, powered by steady cash and disciplined capital, turn into the ultimate billionaire machines. Koch Industries operates in the shadows of Wall Street, but its financial engine is anything but quiet. With annual revenues topping $60 billion, Koch's playbook is built on a cycle most public companies can only envy: retain cash, acquire adjacent businesses, and squeeze more profit out of each deal. Every dollar that stays inside the company gets put to work, not paid out in dividends, not handed over to outside investors. Instead, Koch leadership directs those funds into new acquisitions, targeting sectors like chemicals, refining, and packaging, industries where regulation keeps rivals out and margins are thin but reliable. The secret isn't just buying more companies, it's what happens after the ink dries. Koch integrates each acquisition into its sprawling supply chain, centralizing procurement, logistics, and back-office systems. This integration routinely delivers a 2 to 5 percentage point lift in operating margins. For a business already running on billions, that's a surge in cash flow most tech startups can only dream about. The 2023 acquisition of Infer, for example, allowed Koch to apply its analytics platform across legacy industrial clients, raising segment margins by 4 points in the first year. Staying private means Koch can reinvest nearly every dollar of earnings, compounding value over decades without the quarterly pressure of public shareholders. The result? A private empire that quietly outpaces many public giants, turning steady, unglamorous businesses into a relentless cash machine. 40%. That is the EBITDA margin Mr. Car Wash posted in the first quarter of 2026, nearly twice the average for consumer services. But here's the kicker: 76% of its car washes now come from subscription plans. That means every time a car rolls through the tunnel, the cash is already locked in. In just a decade, Mr. Car Wash expanded from 65 to over 500 locations, fueled by recurring revenue and a playbook that private equity dreams about. When the numbers line up, high margins, sticky subscriptions, and a fragmented market, boring turns into a gold mine. But not every plain business is as clean as it looks. In the late 1990s, Waste Management, America's trash titan, cooked the books to the tune of $1.7 billion. The fallout was brutal. The SEC forced a $30.8 million settlement from top executives. The scandal did not just stain reputations. It proved that even the most reliable cash machines can hide ugly surprises. That is why due diligence is not optional. If the numbers do not add up or management gets cagey, walk away. So, how do you screen for the winners? Start with the acquisition checklist. Look for EBITDA margins above 20%, recurring revenue north of 60%, and a churn rate under 12%. Pay no more than 5 to 7 times EBITDA for deals. Anything higher, and you are buying hype, not cash flow. If a business clears these hurdles, you have found a real contender. The filter is simple: high margins, honest books, and a market that lets you buy small and scale big. That is the billionaire blueprint, no hype required. Right now, the world's richest fortunes quietly grow in industries most people ignore. As hype cycles distract the masses, cash flows compound in the background, unseen but unstoppable. The next billionaire is likely building something you'd call boring. Sometimes, wealth rewards those who see value where others see nothing. What do you see?